All right, hey, my friends, welcome back to Premier Study and Investing. So glad to have you. So, right in front of us, U.S. 10-year Treasury yield over the last year, actually longer than that. This is the beginning of 2020. Of course, we're here March of 2021. You have to be under a rock if you haven't heard some of the chatter about the concern with this increasing, especially if it gets out of control. Yes. So, true or false? Based on what you've typically heard during your time as an investor, equity prices do better or they do worse? It's not really a true or false question. Do they do better or do they do worse when interest rates rise? Look, I've always heard that these low interest rates just kept causing the S&P to cruise higher and higher. Okay, so here I have a transparency of the S&P 500 over the last year. So going back to last March, we can see it fell off, of course, and this is the S&P right here. So continued to increase while interest rates were low, and have still continued to increase even as rates have come up. So it's pretty interesting. I'm going to be looking at another company here, similar. This is a Cooper. Come up over 100% from about 18. About at 18, it's over 36 now, and you can tell they've really had a wild ride as well. We're looking at this line here, and I could size this a little bit better, but I don't think I need to make the point. So I just thought that this would be an interesting overlay, and this video is going to be a little bit more technical. Some of the content I do is more kind of prep or review for CFA students, so I'm in the CFA program, and I thought it would be really helpful. I want to look at a couple articles, and then we'll come back. But this is the one that really got me before I move on. So this is a correlation of the 10-year Treasury and the S&P 500, and it was positive, which was kind of against what I thought it would be, 0.652. So fairly high. Remember, correlation goes from -1 to +1. So +1, perfectly correlated. For example, all these ones, anything that's correlated with itself. So Cooper with Cooper, Ocwen with Ocwen, Penny Mac with Penny Mac, S&P 500 with S&P 500, right, is going to give us a 1. Always, that's how these charts on the correlation look. So yeah, so from -1 to +1, this is a fairly high number. Kind of surprised me. This caret T in X is the yield for the 10-year U.S. Treasury. So, wow. Let's dig a little bit into some articles that I found that I thought were very interesting, starting with this one. This one gives us the standard fare that we're always told. Monthly stock returns are 3 times lower in a rising interest rate environment. Yes, we hear that all the time. I want to look really quickly at this it's the S&P Dow Jones Indices, division of S&P Global, and I'm only going to just do this chart and then read the highlights. We'll look at one more paper. So it's going to be kind of more academic, but I think it'll give you enough information to kind of maybe change your opinion about how Treasury and the stock market is correlated. So this is what the 10-year Treasury yield from 1953 to 2015. So anywhere from like 3%, the big spike. I think this is, so 81, okay, 15%. Was this, I think this was when Volcker came in and increased the interest rates to put the kibosh on the inflation. But anyway, now we're down to 2.36. Nothing that surprising here. So I'm going to start with this. Despite the argument's appeal, the argument being that conventional wisdom is that rising interest rates are bad for equities. Okay. So despite the argument's appeal, however, for the last 25 years, the presumed relationship between equity performance and interest rates have been severely challenged. Windows of rising interest rates were generally small during this period compared to times when rates declined. The periods shaded in teal in Exhibit 2, which you can see, highlights when the U.S. Treasury rate increased. And so if we look at this really quickly, they'll give us, we have U.S. Treasury rates increasing in all these blue sections, and you can see the S&P increased. Here it increased 29%, here it increased 37% over maybe 3 years here, two or 3 years. Up 40% here. So they're basically kind of giving us the exact opposite information that we've always heard. I'm just going to read the bold. Overall, the average S&P 500 return during months when the 10-year Treasury yield declined was less than 1%, so 0.47% versus 1.49% return in months when yields rose. Okay. They're going to give us a lot of graphs, a lot of dot plots. Like I said, I'm just going to read these bold. So in periods during which interest rates have increased, there's no tendency for dispersion to do the same. Okay. But the data give us no reason to assume that interest rates will drive dispersion higher. Okay. There is no consistent relationship between changes in interest rates and changes in relative performance of our factor index sample. Okay. We find no evidence that changes in interest rates can reliably predict equity market performance, equity market dispersion, or relative performance of equity factor indices. I thought this was just really interesting, the conclusions that they drew out of their research. So real quick before we jump over, so remember we said before that correlation can range from a +1 to a -1. Now this is the correlation between U.S. stocks and bonds from about 1900, yes, to maybe 2014, I think. Okay, so generally, they split. Anytime we're above the zero, so anytime we're in this positive area, it's like they move together. Okay, so if one goes up, they both go up together, they both go down together. Either of those scenarios would give us a positive relationship. You know, it's like if they're a couple, you know, you got to think about this in terms of relationships. If they're a couple, you know, they're in agreement. They're both going to go in the same direction. Down here, they're fighting. You know, one's going one way, the other's going the other way. It's a kind of a nightmare. Okay, so we can see this is 1990. This would be 2000, and this is 2010. So we'll say since about 2000, that would bring us here. We're going to look at some QE stuff, but basically for the last, I don't know, maybe 10 years, maybe 9 years, it's always been a positive correlation, meaning that if one goes up, the other goes up. And a lot of people are afraid, of course, going back to this, what if the Treasury yield here, this line here, continues to go up? Isn't that going to be really bad for my portfolio? Might be, but this is an interesting thing to say. Well, if the Treasuries go up, the yields on the Treasuries go up, then the correlation is greater than zero. Stock prices will also continue to go up. You can read these. But I will let you pause and you can read this. These 2 bullet points are kind of interesting, talking about inflation, how that plays into things. This is U.S. inflation and stock-bond correlation. So we have the correlation of stocks and bonds. This is like one thing, and then we're going to compare it to inflation. So you have inflation here in orange, and you have the correlation of stocks and bonds. This is the same graph we just looked at, yeah? This would be the same graph we just looked at in the blue. Now they're just overlaying this inflation stuff. And it looks like when inflation was pretty high, like here, this was negative, okay? Same here, right? Real high inflation during this period, and negative correlation between stocks and bonds, meaning that stocks and bonds are moving opposite from one another when they're below this zero line. Also here, high inflation. So inflation, I would say based on this graph, it's pretty low here. So, and inflation is part of the interest rates, typically it's built in. Okay, what is this? Graph 3, U.S. stock market volatility and stock bond correlation. So this, they're going to use the VIX for the volatility, so that'll be in the red. So, and then this is still, again, just our same graph, it looks like. It's a little bit harder to say, so I'm not going to comment on this one. U.S. stock bond correlation. This is zoomed in, I guess, from about 85 to 2014. So if this is 98, we've almost been positively correlated for 23 years. So this table is interesting. Let me explain it to you. What you're going to have is over here, these are going to be the correlations between the stocks and the bonds in the U.S. market on average. So always positive, either 0.13, 0.34, 0.5, meaning they're always moving together to some degree. Here, more stronger, in these two areas, lesser and lesser. What are these two areas? So you have basically market volatility, so they're using the VIX, and the way they're doing low, average, and high is they're grouping it into, it says quartiles. So what you basically have is like 1, 2, 3, and 4. You'd have 4 groupings, and if the VIX was in the low area, so 1, that would be low, the correlation between stocks and bonds would be also kind of low, but positive, 0.13. If you're in the little bit higher grouping of the VIX, group 2 and 3, then the correlation between stocks and bonds is even more strongly correlated at 0.34. So positive, that's interesting. And then it becomes more positive once you get into areas where the VIX is really high. So the more positive these are, the more that the stocks and bond markets move together. Maybe down together, maybe up together. Correlation with the VIX, this will give it to us right here. So the 10-year Treasury correlated with the VIX. Basically, what does this tell us? We have a negative correlation with the VIX. So if the VIX goes up, the Treasuries are down, or vice versa. So this has a very massive negative correlation with the VIX. Almost negative 9.9 or something like that. Negative 0.5 to negative 0.9. So very, very negative correlation. So the VIX is something to keep an eye on. U.S. interest rate volatility had some spikes in the 80s, spikes in the GFC, and then now we've kind of kept it, I guess, fairly stable. It hasn't been that volatile. U.S. stock bond correlations, correlation of changes in the 10-year government bond yields in S&P 500. So now we're starting to look at what happens when they start introducing quantitative easing, 1, 2, MEP, 3, and now this chops off at the end of 2014. Of course, now people say we're in QE infinity. So what we can basically see is we're looking at correlations between stocks and bonds. This is the zero line. Everything is positive, it appears, in QE. Anytime they're running QE, this little hiccup, this would be what, 2013? I'm not sure what this was. I don't have an event related to that. The stock bond correlations in Australia, Japan, and the UK. So where are we? 2020 here. So again, for the UK, it's been positive since 2020. Japan, positive since maybe almost 95, almost 90, 1990. And then Australia, positive correlation ever since 2020. So for the last 11 years in all of these major markets. And so that's how they conclude the stock bond yield correlation has been positive for an extended period over the past 15 years, in contrast to negative correlations observed throughout much of the 20th century. We'll read the rest of this. An important factor underlying the recent relatively long period of positive correlations has been the considerable and lingering uncertainty created by global financial crisis, which saw correlations rise in a continuation of the pattern observed during other recessionary periods over the past century. The relatively long period of positive correlation is consistent with an increase in the importance of uncertainty about future economic activity in driving investor asset allocation decisions. Shifts in the U.S. monetary policy regimes have been associated with reduced stock bond yield correlations, although it is difficult to distinguish between the impact of recent unconventional monetary policies and the economic developments that have underpinned such policies.